Master your money, free your future. Welcome to Budget for Life. My name is Jeremy. I am not a professional YouTuber. I'm a financial advisor, but this video is not financial advice. In this video, I want to start tying some of the pieces together, okay? Because back when I was doing all this homework, right? Some of y'all in the comments are like, why are you doing all this work, right? The fundamentals don't matter. Well, I told you, I was doing all this so that I could do this. And then I was doing this so that I could do this over here. But now that we have a much higher clarity, a much higher resolution than we did before about GameStop's revenue lines present day and the corresponding margins that they're getting across hardware, software, and collectibles, it means that we are also able to better value the company, and it also means that we're able to better model the company in a forward-looking basis. Today, I want to talk about GameStop's valuation in light of what we've learned from their hardware, software, and collectibles businesses. How does that compare to the most recent time that I looked at their retail valuation? Because their retail business is simply a conglomerate of the software, hardware, and collectibles businesses. So let's fly through this, okay? Because obviously we're going to learn more in a few days when Q3 earnings comes out, and that will certainly impact GameStop's business and how we can model the business. But right now, I still have the same SG&A, which some people would say 800 million is a little aggressive because they're still higher than 800 million. But they are getting closer to 800 million, and we know that there are one-time costs associated with the store closures that they've been doing and that they've been closing stores aggressively. So once those one-time costs are gone, another year goes by, we will see what their true SG&A is. My estimate is that their SG&A really is closer to 800 million already. So revenue for software, no difference there. Still 750 million as a floor case, still declining 25% year over year. But look at this margin number. Okay, 33% in a floor case scenario. But what have they been? 46%. So the margins on software, there's basically no world where the software margins are only 33%. And the reason is because digital is 89%, right? And of course, used software as well, over 60% margins. And the only way that the software business as a whole could approach 30% is if basically the entire used business and the entire digital sales collapsed. And even though the used business is declining, and so is every line, every line item within their software business, they are all declining. But what's declining the slowest is digital, which means the margins are actually continuing to come up even in the midst of this decline. And so, how do you think about the software business? Probably the floor case, you're saying, what if margins come down to 40%? What's the catalyst for that? No, there's no catalyst for that. There's no reason that the margins would actually come down that far. But if basically you think that GameStop can continue to sell new physical games, but for some reason can't sell used games, that doesn't make sense, right? Or if you think digital, I mean, really the real way this could happen is if digital somehow, like there's a technological change that happens where digital is actually continuing to shrink actually very quickly, right? As a portion. And so then they end up closer to 40% when you're just thinking about the used and new physical games. And that GameStop's ability to compete in the digital games is somehow substantially worsened. Now, there's no catalyst for that, but we're just talking about a 10% drop off from where they currently are, right? They're at 46. If they go down to 40, it's actually more like a 15% decline in margins. This is probably too conservative. Let's call it a 10% drop off. What does that do to the valuation for the software business? Well, again, I need to rework these in coming weeks to where everything is modeled out for you and automatic based on the assumptions. But if you take that 750, 42% of that is 315. And then you take out 120 million of SG&A and you end up with $195 million of net profit in basically what we would call year one or year zero for the software business. And then if revenue is continuing to decline 25% year over year, the nuanced view is that the margins will actually continue to increase. Because again, the digital is coming down the slowest of all of them. But in this floor case, we're going to assume that something happens to where GameStop's ability to sell digital games is substantially worsened than it already is. It's already low. It's already a fraction of the total digital game market. But let's say that for some reason it's even worsened from there. In that case, again, the margin's at 42, right? The 750 after a year's decline is 562. You take 42% of that, you end up at 236. You take out the 120, and this is like 116 in 2026, right? And again, you do that the same for basically the others as well. It's basically like a $20 million bump each year. We'll do this a little lazily so that we can keep flying through. The question is then, um, what does it bottom out as, right? So we're taking the present value, again, being kind of lazy, but taking the present value of the earnings that the business will continue to make as it declines, right? But then where does it bottom out at? Right now, we have the software business bottoming out at just $25 million a year of net income, right? Not 25 million in sales, but 25 million in net income. I think that's probably too low of a floor case because, again, even if the physical game market becomes a continued fraction of a fraction, right? It's just slowly eradicating, getting smaller and smaller into perpetuity until it's just so niche that GameStop doesn't even sell them anymore, 50 years from now or something. There's still like GameStop still has the ability to sell digital. And GameStop still has customers that prefer shopping at GameStop, right? So if the customers want a digital game and the customers want to buy them from GameStop and you can buy them from GameStop for the same price you can buy them from, whatever, the Nintendo store or the Xbox store on your console, right? And especially if you can buy them for even maybe a little cheaper at GameStop through your pro memberships or whatever, then it's hard to imagine why the digital in its by itself wouldn't be able to continue producing. And again, digital is so high margin, right? It's 89% margins on the digital sales. And so you're getting 35 million in profit off of just 39 million in sales. And guess what? Digital does not have any SG&A associated with it. I mean, I'm sure it has a tiny bit, but it happens electronically, right? You don't need stores to sell the digital games, right? So the margins on that are pretty substantial. And so where does the business bottom out at? It probably bottoms out closer to like a 40 million in this floor case scenario, right? Which is still very much games are continuing to decline, but overall, um, the margins have a higher floor and a higher present than what was currently modeled. And if this is a stable 40 million, then what type of PE do you give that, right? If it's a stable 40 million, there's no reason why you wouldn't give it at least a 15 PE, right? Again, if it's actually stable, if it's actually stable, which maybe you would say it's not stable yet. You want to be really conservative and say I'd only give it a 10 in this worst case scenario. Fine. But then you add it up, right? What's the cash flow? 195 year 1 plus present value of 104.5 plus 77 plus 58. You're already at a $434 million business plus 400 million, which is 40 million a year at a 10 PE, right? So this business all of a sudden becomes worth, and I guess since this is a 5 year out number, maybe we'll dock the PE a bit again. But still, that's a $360 million long tail valuation. The total ends up being 794.5. And what's the percentage that this happens, right? What are the odds that the margins come down 10% from where they are, that the decline continues 25% year over year indefinitely, all the way to the point where physical games are basically a tiny fraction, right? 5 or 10 million a year coming from physical compared to right now, 200 million in or 150 plus million coming from physical games. I'd say the odds of this are actually lower than what we originally thought, right? So already we've already bumped up the valuation of their software business by over $100 million based on what we've learned. But then we need to work on these weights as well. I'd say what 40, I mean at least coming down to a 40% chance, maybe even 35, right? The margins in particular, there's really I think it's not very likely that the margins come down, but I think it is definitely plausible that the declines year over year continue. So I'll still give it a 40% weight. Now, for the fair case, again, the margins, I'd say fair case are that they just continue right at where they've been, right? That's very fair. And in reality, they're actually ticking up, right? They went from 46.8, or I guess they're not actually ticking up, 46.8 again in Q2. So to say they keep a 46% margin, and let's say they decline at a 10%, let's increase the decline. So instead of the decline continuing 25% year over year, they are able to officially start slowing down the decline, partially because a new console cycle stimulates demand, partially because the company is continuing to gain traction within its loyal customer base. Where does this put you? Again, that 800 million in revenue is 368 million in profit. You take out 120 of SG&A and you are at a 248 million, which obviously is coming down. So what type of profit, what type of PE do you give the 248 in light of the fact that it is slowly declining? Well, again, you see retail businesses that are declining still receive decent multiples. And so I'd say maybe this fair case, maybe you even want to come down a little bit, give it a 13 PE, which 248 times 13 makes this I mean, is 13 even too aggressive? You want to call it 12? Makes this a almost $3 billion business. And again, the odds of this are going to be higher as well. So we've added another 100 million in valuation for their software business. I think the odds of the fly case are still relatively low. So I'm going to shift that 10% from the floor to the fair, call this a 55% chance. And boom, we have added another 300 million. So total, we've added $500 million in value, right now value for GameStop that we just learned through this huge margin project, right? And now what about the fly case, right? Basically the collectiblesization of games, shifting the decline to a we're steadying and actually slightly growing. What are the margins in this case? Again, is there reason to think margins would be considerably higher than the 46%? I don't think there's a huge catalyst for that, but if you wanted to call it 49 just to give you a little bit of a bump, again, you're just saying this is a 5% chance anyways. 5% growth, right? Is that possible? It's certain. I mean, the video game market is growing faster than that. So is it possible that GameStop is able to find its niche within the industry, right? They finally finished cutting costs and reducing stores, and they're actually going to be able to stabilize out from there. I think it's very possible. You probably want to bring this 950 down to an 850 just to keep it within a tighter range. What does that 850 do at 49% margins? It's 416 million minus your 120 is 297. And what type of PE do you give that? Well, it's very high margin, even though it's relatively low growth, which would give you somewhat of a premium PE. But because it's low growth, right, you want to balance that out. But the S&P 500 on average is growing at 10%, but on average is like 10% margins or something like that. So to have this be a comparable PE to the S&P is not actually crazy because again, a lot of this is happening digitally with such low costs as well. Like the SG&A and software is probably going to continue coming down. And we're giving this a 5% chance, right? So I'd say you might as well be relatively aggressive and say, hey, there's a 5% chance that the software business could command a 30 PE, which if it did, that's then an $8.9 billion business. So overall, $700 million of value added to their software business based on what we learned about their software business. Now, if we did the same thing for hardware, same thing for collectibles, hardware, what's the base that we're talking about? I think you can bring down the floor case to probably 2.5. But the reason I put it at 2.7 is because I'm considering Q1 to be obsolete because the Switch 2 is not available yet. But regardless, we know that the Switch 2 also won't sell forever and ever. But let's go ahead and say 2.6 as the floor case. The margins, though, right? The margins that GameStop is getting on their hardware is actually 20%. It's 20%. Why would that come down? If for some reason they're unable to sell used consoles, right, which is not plausible at all, right? Their new consoles, the margins actually get higher in later stage console cycles, right? Up to 25% in late stage, which is what Q1 was. The Switch 2 comes out, low margin consoles, it still maintains over 20%. So the floor case is, probably a relatively high margin floor case scenario as far as how you would model their software business. Um, but let's just say 19, right? Let's say it just gets a little bit worse, and that overall the growth is very modest, right? 5% growth, and that it's a very cost heavy business, right? High SG&A. That 2.6 billion times the 19% margins is 494 million minus the 4 of SG&A. All of a sudden, this is a $94 million profit. You give that a 20 PE, and this is a 1.8, right? So what started as a $4 billion business, we're going to see how much value is added here as well. Right now, I had that as a 10% chance. I think that's still probably fair. I want to give it maybe a little bit higher weight, actually, maybe about a 15%, and we'll see where we go from there. The fair case. So I think where do you start from? Like, what's the starting place? Maybe 2.7 as far as where are they at right now, which right now I'm basically baking in the earnings not just from Q3 and Q4, but the trailing 12-month earnings after Q1 is what I'm considering, right? When you have a full 4 quarters of the new console cycle. What margins are they getting right now? They are getting 20% margins. How fast are they growing right now? Well, they're growing very fast, right? And long term, can they maintain a growth in their hardware business, right? Does each console cycle continue to raise the floor of the overall hardware business? I think yes, and they've said as much in their 10Ks um, in previous years, and they also have the opportunity to grow, right, their electronics business, which they had shrunk to just about nothing. So that's growing again, right? If you want to say that 10% is too aggressive and you think it'll only grow at 8%, fine. Um, and then a PE on that 8% growth with 20% margins, 25 is probably pretty fair. So 2.7 times your 20% margin, you net out your SG&A of 400 million. This is actually 140 and a PE of 25 brings this number down slightly to a 3.5 billion. Oops. One more zero. And then what is the fly case? So again, starting point, maybe bring this down to a 2.9. The margins, you're always blending, right? Like what is the sales level that's going to be sustainable for hardware? And what are the implications on the margins for hardware? Because you have 20% margins on hardware at the very beginning of a console cycle, but they get up to 25% towards the end of a console cycle. We also know that accessories and electronics are items within the hardware business that GameStop is investing in and growing that raise the margin number for hardware. And so again, for the fly case scenario, right, can this actually sustain closer to a 25% margin in the aggregate, right? Not just barely touching 25% in the last year of a console cycle, but actually can basically the next time we're in late stage console cycle, could this actually be even closer to 30% to where the next console cycle it goes back down to a 25%, right? What's the margin on average going to be? Will we see the margins continue to tick up from the 20 that it's currently at, right? It's very possible. And again, could we see a 15% growth? We definitely could. If we want to get a little bit more conservative and call this just a 12% growth, that's fine with me. But you take that 2.9, 25% margin on that, you net out 400 of SG&A. This becomes a $325 million business. And what type of PE do you give that business? I think a 33 is probably pretty fair. You could go 35 easily. It is growing faster than the SPY. And again, GameStop is the only nationalized retailer with a video games focus. So there is somewhat of a rising tide can lift all ships. GameStop continuing to execute as a company can benefit GameStop's market share within the video game industry in the US, right? But you take that 325, you give it a 35 PE, and all of a sudden this is an 11, 375. Now, what do we do with that 5% that we took out of the low case, right? The floor scenario for the hardware. Initially, we dumped it all into fair, but how fair is fair, really? Like it's very mid. Like I've baked in the fair case to be a very mid valuation, which of course is possible, and I would say even likely, but is this type of outperformance, right? Just a couple more billion in sale or 200 million more in revenue and margins that in the aggregate tick closer to 25% rather than 20. I think that's worth more than the 15. And as a result, does that total at 100? No. How about 6, 7? Okay. You end up adding a little over 200 million in value to the hardware business, plus 700 million that you've added to the software business. So we have learned that there's at least $900 million more in valuation on a weighted average probability basis for GameStop, the retailer. And then you have collectibles. And let's wrap this video up. Okay, collectibles sales. We had 2 billion, one from their current business, right? Merchandise plus grading, TCG, raw cards, etc. All of it. Um, and then one from digital power packs. Again, this is kind of on a forward 12 because the digital power packs has not existed before, right? And if so, 500 million of digital power packs represented in the 1.5 for the full year of this year. But if you just say digital power packs are available for a full year, then this 1.5 is 2, right? We don't know yet what the margins are for digital power packs. Right now, I'm just calling it 10%. But for the legacy business, right, 35%. Is that accurate or not? Well, right now the legacy is that it's at 40. It's at 40% and maybe even ticking a little higher. So that's a pretty huge drop off from the current situation as far as the low case of the business. So do I want to change this floor case? No. Is it possible that 35% is the floor of the collectibles business? I think that's still possible, but I kind of want to lower the weight of this because we basically already know, like Power Packs is already doing this amount. And we know that it just started and it's continuing to increase its products and popularity. And the margins on legacy are already much higher than this, right? Almost 18% higher, right? What's 5 over 35? 14%. 14% higher than that already. And so again, a worst case collectibles business of 7.6 billion I think is very fair because again, you're also deducting so much SG&A out of this number even though Power Packs is basically SG&A free. So then what do we do? 40% as your fair case margins, 45% as your fly case margins for the legacy side, 12% or 15% for Power Packs. Again, I think that's relatively fair, and we'll see, right? Fair is that it stays where it is. Floor is that it decreases all the way to 35%. Fly is that it increases to 45%. Margins on power packs, digital power packs, we haven't learned anything new about that yet, so I don't want to tweak that yet. And then these PEs, 45, 55, and 85, I just used um, basically the average SPY break even point, right, is about 13 and a half years. So I just solved for in the floor, fair, and fly case scenario. Let's say that you break even in 11 years in the floor case, in 10 years in the fair case, and in 10 years in the fly case. Here's the little blurb about the hardware business continuing to grow each cycle. Each console cycle grows the overall market of the hardware business. Um, and GameStop said as much in their earlier 10Ks. I found this back in 2014, I think. Okay, all that to say, what type of odds do you put here? I would probably move this 5 just over to the fair case because I'm already giving a 25% chance of the fly case, which is basically that Power Packs continues to explode. Overall, you end up with a $23 billion valuation when it was at 23.2. You make those changes and it's at a 23.7. So $1.4 billion added to GameStop's retail business, right? Because these are all synced up, right? I do believe so. Um, yeah, yeah, these are all synced up. Okay, which brings their retail business up to a $30 billion valuation, almost $31 billion for just GameStop, the retailer. And then you add in the way you value their asset management business. Nothing about this margins project informs us about how you would value their asset management business. It's very much in a SPAC stage currently. So it's just a matter of how you would value that SPAC. But to say that on a fair value basis, there's at least 30 billion represented as GameStop the retailer, and then regardless of how you value the SPAC, the worst you could value this is at cash, right? Which means basically the worst case, the floor case scenario for GameStop is, or what I could say is the most conservative fair value that I could come up with on GameStop is really like $40 billion. And right now they're trading at what? 10? What's going on today on the markets? Oh, they're wanting to give a little bit more discount. 10.1 billion and a conserve like if you don't value the asset management business, you only value the cash at cash, right? And then you value the retail business on a weighted average probability basis. And you could say with the cash, I'm also valuing the cash on a weighted average probability basis, I'm valuing the asset management business. But I'm saying if you wanted to value the cash on a weighted average probability basis, then you would basically say, okay, well, what are the odds that GameStop is able to keep the cash that it has from its convertibles and at no point has to pay it back, right? What happens to the cash floor if even if they do have to pay it back? And look, the cash floor is never lower than it is right now. Never lower than it is right now, no matter what happens. So again, if you want to say there's a 1% chance that they lose some of this cash value and the cash floor is lower, okay, fine. Put that in a weighted average probability, and you're going to get a weighted average value of GameStop's cash equivalent to their current cash, right? So again, 40 billion is kind of like the most conservative fair value for GameStop, and a worst case value of like 20 billion, right? If you didn't value this at all, you only said all the worst things are going to happen to the retail business, right? All the floor, and then asset management, you say it's only worth the cash. You're still at a $20 billion value, which is a 2x from current levels. Great stuff that we learned, guys. Thanks for diving in this project with me. I'm excited in a video soon to talk about how we can actually maybe better model Q3 based on what we learned about GameStop's hardware, software, and collectible sales, right? We have a much clearer picture now than we did before. And using Q2 as a leapfrog starting point to Q3 numbers, we might be able to more accurately project what these lines are going to look like. Obviously, the big X factor for Q3 is how much money is Power Packs and how much is the Power Packs margins. But as we project more granularly Q3 numbers using this model, we'll then be able to plug that in, make a couple more tweaks. My guess is it means GameStop actually made even more gross profit than what I originally projected, but we will see how it all shakes out. All right, that's all I got for y'all today. If you learned something, let me know. Thank you to those who have joined the channel as fans and friends. All the earnings go to DRS-BOOKED GME shares. I appreciate it a lot. Thank you to those who have subscribed to the channel. Okay, we just got 30 spots left in the Halo Sub Club. We'd love for you to be a part of it. Trying to get there by earnings, so just 3 days left. We'll see. Might be a little too ambitious, but if we get there the day after earnings, I will be content. You know, I will be content with that. Also, I might save this actually for a future video. But whatever, I'll just say it now because I started getting into it. But I speculated a couple of videos ago. I was like, would it help the company just as much if one day earnings of the channel went to me purchasing product from the company? I think it, I think you could argue it helps the company more. But my goal in this channel is to align the interests of the channel and the company and the viewers. There's a couple ways I think me using the money of the channel. Obviously, it's like I get it. The channel, like I did the work. I can do whatever I want with the money at the end of the day, but I'm trying to communicate something that I stick to. Here's what I like about 100% of the earnings go to DRS-BOOKED GME shares. One thing I like is that we in the green, baby. That's one thing I like. But it there's a couple things. One, if I buy shares, it communicates that I do genuinely, fundamentally believe in the company. If I'm buying product from the company, then you could argue that I'm just not actually a believer in the company and I'm just trying to get merchandise, right? Also, I'd say all the time how I'm not a professional YouTuber. It's very clear if you've ever seen a professional YouTuber and then you look at the quality of my content, it's very intuitive that I am far from a pro. And if you ever wanted tips on how to become a YouTuber, I'm the last person you should ever ask, right? But one of the building blocks for that is that, hey, I don't make a living wage from my channel. And so when I buy shares, it's clearer that, hey, like not a single penny that the channel's made has inflated my lifestyle at all. And I kind of like that, right? I think there might be value there in aligning with viewers, right? There could be a trust builder with viewers for me to not have any physical benefit, like to not purchase product, for my lifestyle not to improve based on the channel, for none of the earnings of the channel to impact what I spend for myself, right? And also, I think it builds trust with you as the viewers for me to own shares, right? So it's not touching my lifestyle and it's communicating a long term fundamental belief in the company. Those are two benefits, I think, to owning shares, to using earnings all for shares rather than funneling earnings into GameStop product. Of course, we also want to support the company. And so I'm not saying I won't buy anything from GameStop. I'm just saying maybe anything I buy from GameStop will just continue to be money that comes from my own money that I earn from my investment firm as a full time entrepreneur and not from the channel. I also just think I personally think it'd be so cool if years from now, decades from now, whatever, that we can literally be like, look, here's every dollar the channel's made. Here's all the shares, and then to show you screenshots. Here they all are in computer share. Here's the gain we've made. Like, I think that'd be cool to an epic proportion to be like, still haven't sold any, right? I'm still a believer in the company. I still haven't, farmed this YouTube channel for my profit, right? Obviously, it's still kind of my profit because I'm holding the shares, right? But it's not my lifestyle. It's not my spending. And, you know, I think that creates a level of dramatic effect and conviction that communicates something powerful as well. So, anyways, I'm externally processing this with y'all just in case any of y'all have opinions or thoughts. If you don't, it's no problem. But I'm kind of leaning back towards I think I just want to continue 100% of earnings to DRS Book Genie shares indefinitely forever rather than saying, hey, well, maybe after the shares are worth 200 or 400, 800 a share, maybe then I would start buying some product with earnings instead. I'm kind of like, I'd rather just leave them, you know? I'd rather leave them and create that impact, create that trust, create that conviction of the long-term fundamental value. Obviously, if they end up becoming worth $1 trillion a share, then like I'm probably going to sell one share. I'll be forthright about that. If it's 1 trillion a share, I'm going to sell one share. you know, but then, right, you buy back in, like, ooh, swing trading. I don't think I want to do swing trading with my channel earnings though. I think I just want to be like, here's what I got, here's what I made, here's what I bought, here's how much it cost, and now here is the channel's cost basis and gains, and to just stack that month over month for years on years. And one day, if I make videos about other companies, maybe there's like a wider pool. Like, hey, whatever. 10 years from now, there's a Ryan Cohen baby company that I'm doing videos about. It wouldn't be hard for me to be like, hey, here's how much money these videos have made about this company, and all these videos are going to shares of this company, and now we're continuing to grow the overall Budget for Life infinity pool. I could see that happening. That sounds more exciting to me than just buying a bunch of merch and being like, look, I got all these cool graded cards, you know, and kind of like flexing my earnings on y'all via lifestyle. Anyways, if you have thoughts, feel free to weigh down below. Most of y'all have been just super supportive and like, bro, you can do whatever you want. But if you if you get a chance to think about it, let me know if you have an opinion on what you think communicates the most transparently, the most honestly, and creates the most aligned interests for you as a viewer, as well as any thoughts about aligned interests for the channel and the company. All right, that's really all I got for y'all today. I will see you in the next one.